the individual who manages the team that manages the largest small cap fund in the industry currently. Let me introduce my guest for the day. We've got Sailesh Bhan, the CIO of Equity at Nippon India Mutual Fund. Sailesh, thank you so much for taking the time for speaking to us on NDTV Profit.
Thank you for having me.
It's an absolute pleasure to have you in the studio. And while I want to talk to you, as I said, about small cap, of course, I want to talk to you about a lot of other things, but let me start with that.
Sure.
We've seen tremendous amounts of money flow into small caps over the course of this year. We thought that it would trickle out, but it didn't. What do you think about this chase that retail money has for the broader end of the spectrum?
The small cap as a category has done exceedingly well.
Yes.
And the outperformances are very large versus the other spaces. So that has continued to attract money. Like while we think that, the category has definitely very good long-term potential, you certainly have phases where so much money chasing takes away value from that particular space fairly quickly, especially in the tiny cap spaces below 8,000 crore market cap. So we find those spaces still continuing to be little frothy, which is below 8,000 crore kind of market cap companies, because so much money chasing them creates a lot more impact cost. And some of these businesses are trading in unrealistic kind of valuations.
Okay, so I will come to the valuations in just a bit, but as the manager of the largest small cap fund, you took a decision a few months back to stop lump sum inflows. At that juncture, Sailesh, you were already above 30,000 crore assets under management. Why then? Why did you hit pause then?
See, we were clearly seeing the rising impact in terms of when you were buying and selling equities in especially the lower market capitalization space. So when you have a large impact when you're buying and selling stocks in that category, it impacts the returns of the overall portfolio. So it was actually for making sure that, the existing investors are not suffering at the cost of new flows which come, which create a lot of impact in terms of buying and selling, and possibly over a long period of time can lead to investor experiences which may not be good. So the idea was to make sure that we are having time as a team to take right decisions, creating, I would say, choosing better, relatively staying in the better quality businesses within the universe, and making sure that the portfolio quality remains strong and doesn't deteriorate.
Is it a tough decision to take management-wise?
No, we have done this over a period of time. For example, in small caps, for a long period of time, we only took money in a systematic manner. So we've always said, please come to small caps for a 5-year, 7-year period, nothing below that. Because rest of it is luck, if you make money in the shorter term when you come in. But if you spend time of 5 years, 7 years, there are extraordinary opportunities in India.
Okay. You have continued with SIPs, and it's been a few months where you've allowed SIPs of up to 2.5 lakh. My question is there sizable inflow still through that route into the small cap fund?
Yeah, so we welcome SIP inflows because, one, they allow you enough time to allocate and choose the kind of businesses you want to be invested. And more so, an SIP investor comes with a view clearly over the next 3 years, 5 years, 7 years, he expects returns. So there is no near-term expectations which are unreal. One more reason of making, flows contained in the fund is also the fact that you're sending a signal to the investors that you have to be careful when there is euphoria, and you have to use the reverse of a euphoria, whenever there are challenges to actually deploy money. And I think a lot of investors have spread across investments and, increased time horizon. So we expect that to help them get a better experience of the product, as also allow our team to do well in a challenging small cap space.
I will come to the management of that fund, but first, since you mentioned investor behavior, I'm curious, as somebody that has watched several phases and several different market cycles as well, have you noticed any difference in the way that your investors have behaved in the last year or since the pandemic?
So clearly, the returns post-pandemic have been phenomenal for investors. And prior to that, India was in a 10-year kind of a very average return environment. And these returns have also come for a lot of new investors who have come to the market in the last 3-4 years. So they haven't seen challenges as yet. So the way they look at markets is everything will be good, everything is forever, and that kind of a phenomena, right? So our thing is, if you keep sensitizing investors that there can be cycles, there can be challenges, and you do make a lot of money in India over the longer term, but please don't overestimate the short term, because most errors happen in the short term and you don't survive in the long term to really get the benefits of what India has to offer.
Does that make it tougher for you as a manager of money, because those expectations are currently sky high, and I think that's forced you because of the volume of money coming into the small cap, and I keep delving into that because I think that makes a point as well. We'll delve into the other funds as well, but you have expanded the portfolio to beyond 170 stocks, which is sizably, maybe I think it's double the average, or maybe more than double the average holding of small cap mutual funds. Could you explain that to me? Obviously, liquidity is one of the factors.
See, fundamentally, it's very easy to cumulatively put in the same stock which you own.
Yes.
So the idea is to have a diversified portfolio, taking care of conditions of illiquidity in certain pockets of small cap space, which is the nature of the asset class itself. And also the fact that the diversity allows a balance in terms of, you're not kind of dependent on a one-trick pony or one single segment only delivering. Because markets can shift, markets can change. We want the flexibility in a portfolio to be able to navigate across market changes which can happen. And for that, if you have reasonably large distribution, it enables that. To enable that, we have a very, very strong investment research team. So it's a totally 28-member team which is there, which supports the management of money across all our strategies, including small cap. And that allows for, you would say, larger number of companies being covered. So we cover close to 475 companies in depth actively. Sure. And that allows us to be able to have a larger proportion of stocks in our portfolios.
Have you seen a widening or an increase in the size of the portfolio in terms of number of stocks in the other funds that you manage as well?
So in cases where it is needed by design, for example, in which you have a multi-cap portfolio has to minimum have 25 to 30% small caps. So there you would see a little larger number of stocks, because there we run about 3 portfolios, a large cap, mid cap, small cap in one.
Right.
So in some cases we have seen that happen. But the idea is that the core returns generally come from the top 30, 40 stocks at most points of time, because at least in some...
In terms of weight.
In terms of weight. So they would account for 75, 80% of the exposures.
Yes.
And that is where the real differentiation over longer term really emerges. So our idea is to see that, we drive returns from our top, say 30, 40, 50% of our portfolio, because that is what determines the conviction which we bring to the table.
So another factor, of course, is the skew in your portfolio, and you point out that the top weighted companies generally pull most of the load, but has the increase in the size of your portfolio in terms of number of companies forced you to change certain, I don't want to say biases, but preferences that you had in terms of sector? Are you agnostic of sector, first of all? How do you decide the companies you invest in?
Yes, the basic thing is it's more about stock picking, especially in a large number of our portfolios, including small cap, because it's significantly bottom up.
Yes.
In fact, we take away the biases of top down in small cap by making sure that 70, 80, 90% of our returns actually emanate from stock selection. So that's the effort. Okay. And the minute you do it, that means that, it's more attention is focused on one area, not dependent on one macro call or 2 macro calls going right or wrong. And then the emphasis is very clear. I think there's a greater probability of identifying stocks better than calling macro risk better in terms of timing, in terms of doing it. So the emphasis is to get our stock calls right on a continuous basis. And the large team supports that to happen. And that enables, maybe a greater repeatability of performance if we can effort to do this continuously.
Does the current environment make that a little challenging, considering that every small bit of good news is cheered euphorically, if we can call it that, and there is a seismic reaction in the stock price, I think both ways, right? But primarily on the upside.
Where the environment is generally on the upside, the seismic changes or price changes are on the upside, it clearly takes away a lot of value very, very quickly. So it doesn't give you the time to own the kind of quantities you wish to own in businesses.
Which you mentioned at the start.
Yeah, and those challenges come. And clearly these are not easy markets, because in this kind of a euphoria, only you end up making mistakes. So our internal debate always is to make sure that we remain normal in these abnormal circumstances as much as we can.
Okay, I have a very interesting question which I think my viewers will benefit from, which is when to sell, because while we established that investing in equities is a long-term game, and I think that's a well-established fact, the question of when to sell, at what point to book, is a question that is a question for the ages perhaps. But in the run-up to this conversation, I must point out that Sailesh said that there's a very easy answer to that question, and he will tell you about that after this very quick break. Sailesh, to stay with us. Viewers, we'll be back before you know it. Welcome back. You're watching the Mutual Fund Show, and I'm in conversation with Sailesh Bhan, the CIO Equity at Nippon India Mutual Fund. Sailesh, before we slipped into the break, I promised my viewers that I would ask you a question, which I think a lot of people have tried to answer. And you say there's a very easy, very simple answer to this question, which is, when do you hit sell? And you've established at this point that there is a certain amount of froth, especially on the broadest end of the spectrum.
See, interestingly, selling is perceived to be the most difficult decision to make in investing, right? But the whole idea is, why will the buyer buy from you? Yeah. The buyer should expect some return, so you have to sell a little early. So in a lot of cases, we want to maximize the exits, right? Which on our scale is very difficult. So the idea is to make sure that, when there is something in the buyer to ask for it, only then he'll come and own the kind of scale or securities which he wish to buy. So it's more about buying right or buying early and selling a little earlier than where the whole thing is. Even if we get that on an average right, and we are able to, not own for the sake of owning businesses, but, rotate our portfolios appropriately. That itself is very good. So we are not aiming for the highest price to sell. We are not aiming, we are optimal, where there's optimal risk reward achieved in the portfolios, we attempt to exit.
Has that moment to sell effectively, and of course this is something that happens on an ongoing basis, and it has a cyclicality, I would think, associated with it, but have we hit that zone?
See, different pockets of the market are different. For example, in, say, like small caps you are referring to, till about, the whole spread is till about 20,000 crore market cap, from maybe 3,000, 2,000 crore market cap to 20,000 crore market cap. So we see froth generally in, 5, 7,000 crore and below market cap companies. So there, in a lot of cases, that timing has come to possibly book profits, but there's a lot of reasonable, sensible value on the other side. So it's not as cheap as it was 2 years or 3 years back, because those were extreme times. But I think still there is a sensible space in the upper curve of the small cap to participate. And yes, with all this is with the 5-7 year view. It just cannot be with the near-term kind of a view.
Okay, so you mentioned upper end of the small cap space, but I think, so again, we were talking earlier, and the opportunities are also available in the largest pocket, which is not largest pocket, but the large cap space, right? Where some people have already pointed this out, is that the multiples, valuation multiples in those spaces, with a few of the largest companies in India, are trailing some of the smallest companies right now. How do you explain, one, that dichotomy, and have you seen this before? What has happened? What does history tell you about this, one, and how are you reacting to that?
So it's very interesting. The largest of the largest businesses in India today are cheaper than the cheapest, smallest of businesses. And this happens every 3-4 years, so it's not normal. Every time it looks new, but it just keeps on repeating because there is euphoria somewhere. The foreign behavior is very different, so there is, because of risk on there or risk off there, there is an impact in terms of selling which comes about. So I think pocket significant amount of FI selling. Then also you've got some events in the large cap businesses which were, not favorable for near-term returns, which impacted. And also these were, the blue chips of the past, or perceived blue chips. 3-4 years back, they were stocks which people never used to say that they will ever sell in their lifetime, and they've underperformed for 4 years. So those forgotten blue chips are extremely attractively valued today, and these are businesses, which account for, the large caps account for 70% of India's profits.
Yes,
you cannot achieve what the country wants to achieve without this segment doing very, very well. So valuations there are very sensible. The construct of the market keeps changing. What is the trigger? We don't know. But when things shift, I think they will shift fairly quickly for people to work on it. So people today want to focus on the higher riskier segments because that is where near-term returns have been very good. I think the biggest value lies on the other side of the trade, the large caps which we talk
currently. So what businesses are you liking? And you don't need to necessarily go into individual names, but what businesses are you liking? What themes? And the reason I ask is because we're heading into an election year. There are a lot of, I guess, moving parts, even on the global side, which could have a bearing. Crude, I guess, is one. Geopolitics is something that you cannot predict. Crude, therefore, is something that you cannot predict. But all of that into perspective, I guess those are your known unknowns. What businesses do you like right now?
See, our basic single biggest comfort on owning a business is one, it's a very good quality business and then comes at a sensible price. So that points are actually checked very, very clearly, especially in the large cap side of it. Within that, banks, for example, banks are generally trading below 14-15 multiples, and they've got possibly the best balance sheets they would have dreamt of today because they've written off all of it, right? And the whole investment cycle is in front of them. So they appear sensibly priced for the growth they can deliver, and they have enough and more, I would say, credit comfort in the system. So that is one space which is extremely, extremely sensibly priced in the market to participate in. And it's not possible without financials to have a real long-term growth optionality in India, because otherwise they are the guys who will supply capital for all your investment. The second area is the utility space, where growth earlier was a challenge. Growth now doesn't seem to be a challenge for the next few years because of the fact that renewables have come up and people have fantastic companies who have very good balance sheets, have a material long runway, and they can deploy each year 10-20,000 crore rupees, which was never an option before, and these businesses are still sensibly priced after the re-rating. Third, obviously, is the long-term space of pharmaceuticals, which just keeps on compounding given where India stands today. So whatever is good about India in terms of young population is also an opportunity in terms of serving 50+ age group people in India. And 50+ age group is substantially large than any of us can think. And hence that sector is also very sensibly priced related for growth. Lastly, consumer staples as a space. This is the ignored space. These were the darlings of the 4 years back, 5 years back, kind of trading at 70 multiples. They have now normalized to about 35-40 multiples. They're not cheap, but clearly their earning recovery possibility from the current lows because of lower raw material and bottoming out of the rural side could be material for a 5-year period. So that is one space also is getting interesting from, I would say, post the correction of valuation in the last 3-4 years.
Okay, so you've given us the gamut, but are you, and I will spend, I think, in the last leg of this conversation, not yet, on the key risks that you're aware of that are on the horizon and how investors should anchor their expectations, not yet. Yeah. Before I do that, I want to ask you about your expectations on consumption as a theme and what is playing out right now, especially in a scenario where you've had a not ideal spatial distribution of monsoon, and the question about rural consumption being, I think, the largest question that a lot of consumption players are focused on and are worried about. Pricing is a bit of an issue. How are you looking at consumption as a theme, and what are the levers according to you?
Yeah. So there are many subsegments to consumption. Yeah. It's a very, very large market, like you know. So when you look at the premium segment, premium, or you would call a category which is generally used by the well-to-do, the top 10% of India is just not impacted. They're just chugging along, possibly in the best spending power they have had ever in years, and that's all visible in how premium is working. For the last 18 months, rural has been struggling for various reasons. The post-COVID recovery was a little imbalanced. where you only had, it was a classic K-shaped, as you all know. So the recovery of the rural segment, or even the urban poor segment, has been fairly weak. That, I think, is seen 16, 18 months of, I would say, seasoning, or 16, 18 months of pain. And the base is very, very low for that. Right? Government's infrastructure spend is starting to matter a lot.
Sure.
So monsoons may not be the only decider.
Yeah.
And there's a lot of activity starting to happen in that side. So I think it's very difficult to imagine that on very low growth of 0.02% in a 12-month, 18-month period, that you will not come back to meaningful growth in the next 2 or 3 years. So I think
so it's poised. It's poised to take off.
Yeah, it's poised.
Over what period, Sailesh, do you anticipate? And so people look for lead indicators.
Yeah.
What specifically are you looking at?
See, I think the rural recovery has possibly bottomed out, because there's been, in the last now at least 3-4 quarters, 2 quarters at least, there's been commentary on some improvement in activity and demand, right? And the peak of inflation is also behind. So it's not easy, but it takes some time to recover from an inflationary period. But I think we have passed through rising inflation, hurting inflation. So we're possibly at a higher level, but I think that should come into the base. So we think you will get in the next maybe 2 or 3 quarters a meaningful uplift in the rural side of it, supported by infrastructure spending which is happening, supported by just normalization of the fact that the stress in the system is out, because the COVID stress remained 1.5 years after COVID ended also. But that possibly we are coming out of it totally. So weaker inflation is a very good signal to the fact that there can be an improvement in terms of demand. And that would mean that it takes 2 or 3 quarters, because it's a large cross-section of population which comes into consuming side of it. And I think we can get to see that. Mind you, premiumization has not stopped. So it's happening at the upper end. It's just that here there is a struggle of a different kind. But I think it's a matter of a few quarters where it starts getting reflected in terms of broader demand.
So, okay, so I take that. I do want to ask, and you didn't mention IT when you spoke about the legs of growth that you see, because I think a lot of people are expecting there to be a little more pain, considering what you're seeing globally and discretionary spending and all of that. I won't ask you about that. I want to ask you about pharma instead.
Sure.
And you've been a huge proponent of that theme. You mentioned that India domestic demand itself is very strong, but there are a lot of companies that are outside focused. What, according to you, which spot are we in that journey? Do you think that there's still significant value to be found right now on the table?
So interestingly, pharma has many sub-segments, right? The single most important sub-segment is the domestic space. The domestic branded pharma, all of us which we consume to get ourselves treated, right? That space is done exceedingly well in the last 20 years, and a similar opportunity exists. So a lot of under-penetration is there. Diagnostics has become extremely, extremely cheaper, right? And people are getting more and more compliant than they were before.
Yes.
So it's very important. So whatever is wrong, for example, among the largest cardiac populations, largest diabetic populations in the world, thyroid is a crisis, respiratory issues are there. So I think when you look at it, there's a lot of chronic problems India has. And when companies start servicing them, right, and people living longer, it creates I would say, a multiplier effect than a normal cyclical or normal structural effect, more a multiplier kind of an impact. Today, a large cross-section of India, 30 crore people, are over the age of 50. And all of us know 50 plus consumes much, much more medicines than, under the age of 50.
Yes.
And that is rising faster.
I said that I want to ask you about anchoring expectations and the key risks, but I do want to slip into a very quick break before that. Viewers, do stay tuned. This is something that you should definitely want to stay tuned for. Welcome back. You're watching the Mutual Fund Show, and we've had an insightful conversation already with Sailesh Bhan of Nippon India Mutual Fund. But the last leg of the conversation, Sailesh, and this I think is perhaps the most important for investors to pay attention to right now, which is anchoring of expectations and understanding how much to expect going forward. Is there cause to be very cautious right now?
See, clearly we have seen phases where investors overestimate the short term and actually underestimate the long term. And the same seems to be happening in certain pockets in the market today. So globally, the world is in a slowing environment. It's not in a roaring or a recovery phase in that sense today. So that puts a cap as to how fast Indian companies and businesses can grow. So however strong the domestic market and X percentage of growth does come from stronger global environment. So that's one area you just have to be careful about. Second, obviously, the geopolitical environment is not in the best of shape. So while it impacts global growth, it also impacts your ability to take right, meaningful decisions fairly quickly, because you have your investors when they put in, or companies when they put in larger capital, do think about all these things. So they just slow down in their decision making a bit. So I think these two aspects are important, and also the fact that we are paying well for the good news. So it's no longer an extremely cheap market that you can blindly write checks, right? So you do have challenges coming from the fact that markets have also done well in recent times, and hence return expectations have to be moderate, at least for the near term. And then when things improve, when global growth comes back, the possibility of India delivering faster growth and stronger than what it is today does exist.
So last question, you pointed out over the course of this conversation that there is significant value available at the larger end of the spectrum. If you were to approach this as an investor, of course, you are a fund manager, but I'm saying putting on the hat of an investor, would this be the opportune time to rebalance if you've seen significant upside in your portfolio that is oriented towards the small caps?
Clearly, it's a time where people can rebalance, because generally the market construct is 70% large cap and 30% non-large cap, the mid and small cap combined. If investors, because of the strong performance of the small cap category, have a much larger proportion and don't have 6-7 years of holding period from here, can use this opportunity to rebalance, because the larger cap space certainly offers at least a sensible priced risk reward in the market today.
All right, that's the last word. Mr. Bhan, thank you so much for taking the time and for speaking to us on NDTV Profit. And to you viewers, thank you so much for tuning in to the Mutual Fund Show. Don't forget to let us know what you think on our social media platforms, and do stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.